Right now, it's time for a look at what's working in the markets. Joining us for that is Greg Branch. He's managing partner at Veritas Financial. And Greg, it seems that right now just about everything's working. You can look at anywhere you're going to go, with the exception maybe of treasuries, but everything else seems to be working.
It's working. And part of that is due to the fact that we have well underestimated the earnings power in some of these sectors in the economy. When you looked at consensus, even still today, it's reflecting 70 to 75% of pre-pandemic levels. And that's wrong. And we know that that's wrong as we see all of these earnings upgrades across the board, the velocity of earnings upgrades. We know that that's wrong because we see earnings surprises across the board. And so consensus is catching up in large part to what the earnings power is going to be this year. And as long as we have those upward revisions, as long as we have those earnings surprises, there'll continue to be a tailwind in some of the sectors and some of the companies.
Greg, there's an interesting piece on the B1 page of the Wall Street Journal today, just a column about what if the Fed's wrong. The market right now seems to be buying at hook, line, and sinker, at least if you're looking at all of these issues, that this inflation is transitory. But he points out that if you're looking at even ex-food and energy, those CPI prices, they're up 2% over the last 3 months for an annualized pace of 8.2%. I mean, that is pretty shocking if that turns out to be the case. What if the Fed's wrong? What if things have to move faster than we had anticipated, or they had anticipated?
Becky, I actually do believe that the current view of the Fed is probably wrong on two counts. The first with regard to inflation. The supporters of the current stance point to base effect, and that's largely true when you look at the year-over-year number. But when you look at the month-over-month number, we still have two of the largest increases we've seen in 30 years. It went up 90 basis points in April, and then another 74 basis points in May, and that has nothing to do with base effect. That's real price increase. So it's likely, particularly if you look at the commodity PPI, which is a good leading indicator and is hovering above 17%, that this is in fact not transitory. I'd also point to the labor market. We have a job consumption problem, not a job growth problem, which is what the Fed's traditional tools that it's using now has been meant to solve. It's been meant to stimulate job growth in order to get the labor market full. Our labor market's not full because of lack of job openings. It's not full because of lack of job consumption. And so I expect the Fed to reconsider both positions. A, that this inflation that we're seeing will be longer in duration and more acute than they've forecasted to date. And B, whether there's different policy we need to look at, because easy money and a historically accommodative Fed was meant to stimulate job growth, and that is not the problem we're facing.
Yeah, 9.3 million job openings just in April. That's the highest level since all the way back to at least the year 2000. Is that part of the reason that you like financials right now, Greg?
I like financials because I expect the Fed to change its position at least this year, at least the position. I expect there to be rises in rates earlier than the market's expecting, probably early next year. And in a rising rate environment, that obviously makes the net interest margin environment a lot more positive for financials. And while multiples aren't depressed anymore, I still think you get that in combination with continued robust capital markets, continued robust investment banking and advisory, and pretty sizable reserve releases as a tailwind as well, given that credit's been much better than expected.
I guess we should point out it's the big diversified financials that you like, names like J.P. Morgan, Bank of America.
That's right. And so I'd focus on those that have shown us that they can do it, the J.P. Morgans, the Morgan Stanleys, the Goldman Sachs, and the Bank of Americas of the world, for sure.
You also like retail, and I guess that's partly because there's a lot of money that consumers have in their pockets, additional savings that they have, too, and they're starting to spend it.
Partly. And I'd like to focus in on value shopping in particular, because as inflation becomes more acute, as it affects more Americans across the board, we have to remember that elevated savings rate was really concentrated in the higher socioeconomic groups. But as inflation rises and takes more of a bite out of the American wallet, I do believe that value shopping will emerge more as a trend. I believe that the value shopping entities will continue to gain share. And in particular, I like those that have really invested in their e-retail capabilities during the pandemic. talking about the Targets and the Walmarts of the world that have put money into fulfillment centers separate from their on-floor shopping, that have shortened the duration of delivery, that are leveraging all the data that they're collecting in terms of leveraging that on their on-store platform as well. And so while I like the group as a whole, I think that those names will have structural advantages as we move forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.